You ever get that feeling that you're working harder, but your money just doesn't seem to go as far as it used to? Well, that's not just a feeling. It's a hidden economic force that's quietly reshaping your entire financial life. So, in this explainer, we're going to break down exactly what inflation is, not with a bunch of confusing jargon, but with a clear, straightforward look at how the system actually works.
To really get a handle on this, let's start with something super simple, a Big Mac. Back in 1967, you could get one for just 45 cents. Today, that same burger costs around $5.50.
That's an increase of over 1,000%. It's a wild number, and this one simple example really shows you the powerful long-term effect of this economic force. But here's the real question, right? Has your income kept up with that? For most of us, the answer is a pretty clear no. And that gap, the one between the rising cost of everything and how much your income is growing, that's where the problem really lives. This massive price jump didn't just happen by accident. It's the direct result of a constant economic force called inflation. And look, a lot of us really felt this kick into high gear recently. In June of 2022, US inflation actually hit a 40-year high of 9.1%. Now, since then, it's cooled off to around 3%. And a lot of people saw that lower number and kind of thought, okay, problem solved. But this is the critical distinction that most people miss. When inflation slows down, prices don't go back to where they were. They just stop climbing so fast. They stabilize at a new, much higher level. And it's that structural change that quietly creates winners and losers over time. So to really understand this, we need to look at the core concept. It's so easy to just focus on rising prices, but the real story of inflation is actually about the declining power of your money. So officially, inflation is just the rate that average prices go up. And what that really means is your purchasing power goes down. Every single dollar you hold simply buys you less stuff than it did before. In the US, the way we measure this is with something called the Consumer Price Index, or CPI. It basically tracks a basket of common expenses. And what's really important to notice here is that housing makes up a full third of this entire index. That's exactly why rising rent or mortgage payments hit your personal finances so hard. Now, a 3% rise in 1 year, it might not seem like a huge deal, but here's the structural issue. Inflation compounds. At a steady 3% rate, the value of your money gets cut in half in about 24 years, not because of some big market crash, but just because time is passing. So what's actually driving this whole process? Well, the mechanism behind inflation really just comes down to the fundamental relationship between supply and demand. Imagine a small town, and suddenly everybody in town gets more cash. They all rush to the general store to buy one of the 10 bikes they have in stock. But now you've got 50 people all trying to buy a bike. The supply is fixed, demand is through the roof, so the owner has no choice but to raise the price. Okay, so if we scale that little story up, economists really see three main drivers. You've got demand pull, that's our bike example. Then there's cost push, which is when making stuff just gets more expensive. And finally, monetary expansion, which is when the total supply of money in the economy goes up. It's almost never just one of these things. It's usually a whole chain reaction. And the past few years give us a perfect example of how these forces all interact. That massive inflation spike during the pandemic. That was one of those rare moments when all three of these drivers aligned at the exact same time. Here's a quick recap of the story. In 2020, over $5 trillion in stimulus money flooded the U.S. economy, all while interest rates were basically at zero. Then, in 2021, global supply chains just fell apart. So you had demand way up, supply way down, and by the middle of 2022, inflation peaked. The response? The Federal Reserve started aggressively hiking interest rates. And here's a really important detail about that response that most people don't realize. Higher interest rates are a deliberate tool. They are designed to intentionally slow the economy down. By making it more expensive to borrow money for cars, for homes, for business expansion, the central bank's goal is to reduce overall spending and cool off that high demand. And this brings us right back to that crucial point from before. The result of this policy isn't lower prices. It's that prices just stop rising so quickly. That higher price level we saw during the inflationary period, that becomes the new normal. It's the new higher baseline that we all have to operate from. This is where the story really gets personal, because there are two incredibly powerful compounding forces at play in your financial life, and they are perfect mirror images of each other.
On one side, you have inflation. It compounds against you, steadily eating away at the value of your cash. But on the other side, you have investment returns, or compound growth, and that works for you, allowing your money to generate even more money.
The power of this positive compounding really becomes clear over time. Let's say you invest $1,000 at a 7% annual return. It nearly doubles in 10 years. But after 30 years, it grows to over 7 times what you started with, because the growth just keeps accelerating.
So the metric that truly matters then is the gap between your investment growth rate and the rate of inflation. This is what we call your real growth. If your assets are growing faster than inflation, you're actually expanding your financial options. But if you're just holding cash, you're watching those options shrink. You're on opposite sides of two very different compounding systems.
Okay, let's bring this all together. It's really important to understand that a modest level of inflation isn't an accident and it's not some temporary glitch. It's actually a structural feature of our economic system. It's designed to encourage spending and investing over just hoarding cash, which is what keeps the economy moving.
And here's the uncomfortable truth that comes with that reality. Doing nothing with your money, just letting it sit in a checking account, that's still an active decision. And in an economy with persistent inflation, it's a decision to let your purchasing power slowly fade away. Understanding this really shifts your perspective. You stop reacting to price headlines and start designing your financial life around a constant, underlying economic force. So the final question then is a pretty simple one. Inflation is always compounding. Are you?